Hey, Mike Sinabaldi here. Welcome to my weekly technology market recap. I'm here to inform you and hopefully teach you how to stay on the right side of the technology trade and to give you a few scenarios for next week. So let's get after it right after a quick disclosure. I'm not a licensed advisor, and everything I'm about to show you is for informational and educational purposes. I can't give personalized trading recommendations or advice. So please read my important disclosure notice. What a week it was on Wall Street. We got new all-time highs in the NASDAQ on Tuesday and followed it up with the all-time high in the S&P 500 on Wednesday. Then the floor fell out, leaving the NASDAQ 100 down for the week. I've seen this many times in my 20-plus year trading career, and it's astounding how repeatable the pattern is. I call this pattern from Mariana Trenches to Everest, and it always resolves when the last sucker has been found. Essentially, it's a game of musical chairs played out in the futures market. Let me show you how this works, because understanding it ties into the remainder of the video. So hang in there while I explain it quickly. Take one quick look at the S&P 500 weekly chart. It's been grinding higher forever and a day. While buying at the lows offered the best risk reward, it's got to be unnerving for those laggard longs as they are weak-handed and never know when the music will stop as price continues to advance and they accept diminishing returns in exchange for greater risk. I mean no malice to these momentum chasers, but most can't make it to the top of Everest or to top tick the market. It's never that easy. The top or swing high on any time frame is the price where only a few contracts exchange hands and nobody is left to buy when the market begins to fall. While I don't have the chart annotated, the technical pattern is wedge-like in nature, and wedges in terms of Elliott wave are usually terminal patterns. What else can we discern from the weekly chart using log scaling? What I'm about to show you is how I evaluate the S&P 500 and NASDAQ markets to prepare for the next trading week. After all, the S&P 500 has a large percent of big technology stocks in its construction. Sometimes I use a linear regression, then a trend line to get an idea of how far prices moved away from its mean. Here the center line represents the mean, and the upper and lower bounds are 2 standard deviations away. The further prices from the mean, the more it's likely to revert. Clearly, prices reverted to the mean several times. Another consideration is that volume always leads price, and it's been declining throughout the advance. This means that there's less participation, signaling a weaker bull market phase. This is another sign of a terminal Elliott wave pattern. Moreover, look at the most recent weekly volume bars that I've circled. They represent distribution, where shares were sold to those climbing Everest. Now, something that I'm always watching is what's going on with multiple time frames, because market makers and algos exploit signal traders, and one of their favorite signals is MACD. At monthly chart level, the S&P 500 is in an uptrend and will require a print of 39.3485 to generate a sell signal. At weekly chart level, retail is selling. It's a confirmed signal, but it's weak, meaning that any decent buying could catch shorts off guard and turn the signal back to a buy. Lastly is where the rubber meets the road. It's been on a sell signal since July 15th, and price would need to rally to 44.1854 to issue a buy signal. That's not going to happen anytime soon. So what we have learned is that the weekly and daily time frame participants are sellers, while the monthly players remain long. Let's quickly look at the NASDAQ. Here we see it's also channeling, but it's failed at the mean. The monthly time frame is on a buy, but getting closer to that MACD sell that comes in next week at 14,681.38. The weekly time frame remains on a buy. But here again, the daily time frame, they were sellers 3 days ago, and it would take a print above 15,196.89 to generate a buy signal. So here's a hint. Study these charts carefully and look where signals were taken away from the initiating side. Powerful moves often result from them. Let's quickly review sector performance, and we find that technology is the sixth best with a year-to-date return of 12.1%. However, for the session, tech was down 0.87%. The index has a non-confirmation, where price reached a new high, but relative to the S&P 500, it didn't. Are you viewing this as a bearish signal? Now remember when I told you that the Mariana to Everest game is played in the futures market. Here is the NASDAQ E-minis at daily chart level. From May 13th low, price advanced 16.17% in 42 trading days at an angle of ascent of 50 degrees. This is above the optimal angle of 45 degrees. So it's fair to say that the advance is steep, right? So at the very least, traders should be considering the possibility of a larger pullback. Now at 30-minute chart level, using candle construction, we see the structure of the decline. There's some impulsive behavior to that decline. We can also look at the exact same price action using market profile. The close on July 15th RTH session was roughly 14,770. The Globex high for July 16th was 14,853 and the low 14,735.75 respectively. Traders were net long overnight. That's right, the dip buyers. Now the market opens on the 16th and drives higher, taking out the overnight highs and then fails. Closes on the lows, a very bearish signal. Professional traders and prop desks will hold over the weekend, looking for a continuation on Monday. That's just how they roll. As the day unfolded, and well before the close, I made the following social post from my options Twitter account after observing a key technical level that if broken would open the door to lower price discovery. 14,707.75. We've closed below it, but why was that a key reference for me? Because the weekly composite profile showed that the level was where the most volume traded during the prior week, and a loss thereof opens the door to trading at levels where there was much less volume traded. So what comes next? Are we selling, recovering, or chopping around? These are the scenarios you plan for, and then watch how price reacts to the levels that you've decided are significant. So here's my process using market profile on a daily chart and Fibonacci series. You can use any time frame, bar, or candlestick chart too. It works the same. Just use the time frame that you use for context. First, I find the Fibonacci expansion levels from the distribution pattern, which is enclosed in a blue rectangle. Then I find the Fibonacci projections, and you may want to add additional levels that suit your style of trading. Next, I transpose them on a weekly composite profile, noting levels of agreement and the major levels of chart support, which is 14,540.25. That's it. Now you've got your blueprint for next week. I hope that you've enjoyed this market recap and how-to video. If you did, subscribe to the channel and hit the notification bell so you don't miss any of my new content. Before I wrap things up, did you know that you can join the conversation and get daily updates, live screencasts during pre-market hours of the opening on big tech and cryptocurrencies? Join free today by clicking the link in the banner of my channel.